welcome to this live edition of Capital Ideas TV. Our guest is Ryan Irvine. He's the founder of keystocks.com and the president of KeyStone Financial. You know what? I've got my my computer volume on here. Hold on 2 seconds. Should have done that beforehand. Pardon me.
The beauty of live TV, right? Yeah.
Sure, we're fine. Now, Ryan Irvine is here. He's also the president of KeyStone Financial, and he is a small cap stock picker extraordinaire and a stock picker in general, one of Canada's most successful stock pickers, especially of small cap companies with growth potential. He has an impressive track record. We will get to that in a moment. Now, today, Ryan has 5 top picks for you. They are cash-rich, profitable Canadian growth stocks. He also has a bonus pick for you, and Ryan will give his opinions on the current state of the market, what he's learned over the years, and what his experience tells him now. You can ask questions of Ryan by typing them into the chat section on the right-hand side of our YouTube channel. You can see that on the channel you're watching right now. And we'll try to include as many as we can. We'll get to Ryan Irvine in just a moment. First up, a look at his bio board. As mentioned, Ryan, the president of KeyStone Financial, the founder of keystocks.com. This is an independent stock market research advisor firm. Ryan has his Bachelor of Business Administration. He's a regular guest on BNN Bloomberg and Money Talks with Michael Campbell, which is a radio show. He's right here in front of me. Hello, Ryan Irvine. How are you?
Hello, it's great. I love this format. I'm really excited to be on, and we get into it now. It's great.
All right, let's kick it off here. So there are many watching right now who know exactly who you are. There are some watching who may not know. So tell us about
Keystone?
Well, Keystone Financial and keystocks.com.
Yeah, I mean, we are an independent research firm. All we do is recommend stocks and research stocks. That's what we spend our days doing. We have no lives, so we just go out there and research companies, and it's a passion for us within our company. We've been around for almost 2 decades now. It's going into our 20th year. We're fully independent, so we don't get paid by the companies that we recommend. That would introduce a bias. There are some out there that do that. We would not do that. We also don't do financings for companies. So again, if you're doing a financing for a company, it introduces a bias if you're going to be having coverage on that company. So all we do is work for our clients who are individual and some institutional investors across Canada and now into the US. And they pay us to find the best small cap or income related companies, and now we've moved into US coverage. So we ask them to pair our service, our research service, with a discount brokerage. So you can use any of the big banks' discount brokerages, and it's a low-cost way to trade. And we ask them to buy, say, 10 to 20 stocks over a 6 to 18 to 12, 24-month period, and just create that really good, solid growth stock portfolio with good, solid growth-related companies that trade at reasonable valuations.
Now, as you drink that liquid, I'm going to tell everybody that is the water. It's not vodka.
Yes. Unfortunately, just water today, right?
Okay.
No, it's good for us.
No, we want you sober.
Yeah,
I'm definitely sober.
You could get a lot more out of me if it wasn't, but maybe that would be for another time.
Yeah,
right?
okay. Yeah, we'll roll up our sleeves and we'll do that another time. So one thing that amazes me about you and Aaron Dunn, your colleague, is that you literally, on an annual basis, review 3,500 companies. How do you possibly do that?
Yeah, well, like I said, we have no lives, right? And we say that all the time. So we cocoon ourselves in a room and do this. No, it actually takes about 2 to 3 months to go through that many. We have a very specific criteria that allows us to get through these companies. So we're on CDR looking at these, looking at all the balance sheets and all the MD&As of these companies. Now, unfortunately, in Canada, we can right away dismiss summarily about 50% of the companies because they don't even have a top line in terms of revenue. That would be our first criteria. So we're swiping right on them. We're done. We're done with that company.
All right.
If I can use that reference.
Sure, you just
Hopefully.
did.
I just did. So no, we swipe right if we don't, and then you get up to about 75% of the companies dismissed right away when you go to the next item. That would be earnings or cash flow. So if they don't have those, we're just not even pursuing. We're not looking further into those. So there's only about 25% of the companies in the country. Suddenly you've eliminated 75%, and you're digging into those companies more. And then we look at a balance sheet. If the balance sheet doesn't have what we like, if they don't have a good solid cash position, or at least debt is not an evil thing, but particularly in the small cap area, which I will talk about today, we love companies that have a good solid cash balance, maybe a net cash position, because they can survive and even thrive in a downturn. So I mean, those are great businesses to do. But we go through those companies rather fast, if they don't have that specific criteria we're looking through for, and then we dig into the companies and really, interview management teams when they have, what we are looking for in terms of cash flow, trading at reasonable valuations, good solid businesses, and there's a number of other boxes we like to check off, but that's a good start.
Now, you mentioned you've got a 19-year track history, and in your small cap portfolio, your updated number as of the end of 2017 is an average annual return of 36.8%. So
Yeah.
how the heck do you achieve that?
Well, I think you have a rigorous criteria, and you try to avoid losses, and then you have some outstretched gains with companies like we'll mention later, Boyd, right? It's been in the portfolio for 10 years. That really helps bring up your returns. It's the best performing, stock on the TSX over that time.
Right, Boyd Group Income Fund.
Yeah, and great company, good example of the type of companies that we like, basic, boring business that all it does is make money. But avoiding the losses, like we talk about companies to avoid, hot thematic investing, theme investing. At the start of this year, I love to use real world examples. So we were told, and heading into this year, we were told you need to be in blockchain or crypto or those type of stocks, that segment. Now, we did a full sweep of that segment. Our clients demand that we look at it. We look at every company, but we did a sweep. Now, none of the companies met our criteria. So that helped us avoid, this was a sector at the start of the year you have to be involved in. You have to have that in your portfolio. The average stock in that segment in Canada is down 75% this year. So that's your cautionary tale where it just those would never make it into a recommendation for our clients in our portfolio because of the fact they didn't have the current cash flow, they didn't have the current revenue or earnings, and there was no way for us to value them, so we're swiping right again on those companies, and it just helps us avoid those catastrophic losses, because if you have companies, that you have a 70-80% loss in them, it can really destroy your returns in your portfolio. It is tough enough in the market to find great companies when you stick with that stringent criteria with cash flow, earnings, and reasonable valuations. We're not going to get it right on every company, even doing that. You're going to have losses, and we always tell you, if anybody tells you you have a system that, they can pick 10 stocks in a year, they're all going to go up, I'd walk out of the room or walk away from that person, because it's not true. Like, we will make mistakes, but if you can try to avoid the catastrophic mistakes, that helps bring up your portfolio, and then get the winners that are outstretched gains in your portfolio. That is how I think you pull up your returns long term.
Mea culpa for us at Capital Ideas on blockchain. We did a number of interviews with a number of companies, and admittedly, some of them were compensating us for awareness campaigns. So they come on here, they want people to know about the company, so we do those interviews. But you're right, that was a hot sector for a while. Hive blockchain is an example. I don't want to delve into this too much, but I've just been noticing lately it's literally a penny stock after screaming out of the gates and being nearly a $6 stock, I think it was at the time. But let's leave that there. Let's move on to, you touched on it a little bit, Ryan. So again, with your history and your experience, what have you learned as to, and again, you've talked a little bit about it, but as to the keys to successful investing?
Yeah, I think one of the things is don't step outside what you're comfortable investing in your box. Like, we have our box, our specific criteria, and if we're pulled outside that, I'll use the cryptocurrency blockchain related companies as an example again. It looked tempting to be there because you saw tremendous returns at one point, and people were buying it, just on FOMA, fear of missing out. And if you take FOMA, if that becomes part of your investment methodology, you're going to make mistakes. Stick to what you do. Stick to the cash-related companies, the cash flow in businesses. Sometimes it can be, at the time where you see, a hot sector going up and you're not participating in it, it can be difficult, right? And you have that fear of missing out, but you have to be disciplined and stick to your criteria, stick to your knitting, do what you do best, and you will miss out on some companies. We'll miss out on some, but we're going to miss out on the catastrophic losses that we saw in that segment this year, which is what we really want to do. And then we're going to stick to those, in the long term in the market, it doesn't have to be more complicated than if a company makes more money, produces more cash, the share price reflects that over time. So that's what we're trying to do, really look at a business simply. And we teach investors too, we teach our clients, to look at that investment as an owner. You're an owner of that company when you have a share in the company. And we all know this, but you really have to look at it that way. So, if you keep it simple and understand that you are investing in a business, and that business needs to make money for you to make money over time, you'll do well, and you'll be far ahead of the average investor out there who, kind of has that fear of missing out, plays hot themes. Stick to good, solid businesses that you would want to own, that you'd want to, manage or run, and those are the businesses that make you money long term.
Let's talk about the current market. Based on what you've seen over the years, can you compare it to other times? Because it is interesting where a lot of the Canadian growth stocks, for example, they've sort of been taken out and shot one by one. Look at the tech stocks in the States as well.
Yeah.
That was such a hot sector. So tell us about this current market, and also get into the idea that it's actually, it could be a good time to buy. This is when you make your money, and you mentioned that in the piece you wrote for our digest this week.
Yeah, and I really believe that. You do your best work, and we do our best work in a down market, and that's where you do make your money. You dig in, you do a ton of research, and this is where you buy the companies. I mean, you bear the fruits of that labor, a couple of years in the future, but now is when you can find those companies. Now, we're not saying there's blood on the streets or anything like that, but we are seeing companies get punished. There was a razor-thin margin for error out there in terms of earnings, because you saw a number of companies. Like I use the example Premium Brands, which is a business that we love and we've owned in the past and sold. I think it's a great business, but was it trading at reasonable valuations ahead of their Q3 earnings? Now, the earnings were, there was still growth there. It was solid growth, and they have a growth outlook going forward. I think it's a tremendously well-run company. But the premium valuation that the company had, there was no margin for error, and when they guided lower going forward, the stock got hammered 20% in one day. That is your cautionary tale. Great business, but was it trading at sustainable levels or a reasonable valuation? At that point, we didn't think it was. It's starting to enter that category, but even with the significant cut that you've seen in that business, it's still trading at a premium to peers. So, like I said, we're going to do our work now, but is that company really a good value right now? Maybe 2 to 3 years out right now, it's probably a good time to start looking at a company like that because it's well run. But is it value right now? More value than it was, but not strikingly cheap. So we got to look at all these companies that have been hit and see, have we hit a level where they are cheap? Some of them have, some haven't, right? So, and we got to look very individually on each individual company. But there is a heck of a lot of jitters right now.
You're watching Capital Ideas TV Live with Ryan Irvine, and we are talking to Ryan about his investment philosophies. And we're going to get the top picks in just a moment. We're taking your questions as well. I see in the chat we have Thomas Panett. He's asked a question, and we may or may not get to that later, assuming that Ryan knows about the company and can talk about it. But thanks for your questions. Keep them coming. We have another one on Viamed, which we're definitely getting to. That's from Jay Lee. So you're tuning in part because you want to hear these top picks from Ryan. These are all small cap Canadian growth companies. Let's start with XPEL Technologies. Here's a stock that you recommended just over a year ago, it seems. Yep. Stock rose as much as 370%. It's pulled back a little bit, but holding up nicely. So tell us about XPEL Technologies.
This is a business that we've been looking at for 4 years. We'll often, have a company on our monitor list for an extended period. We always liked the business. There was good growth there. We liked the management team, but the margins that it was pulling out weren't in line with the profitability levels that we'd like to see. Now, it was September of this time last year when we looked at the company. Great little business, boring. I'm sure the CEO will hate me saying that, but all they do is make money, which is great. So we like that. But they have automotive film that they sell, retail, and market for their distributors, and window tinting film. So the film that you put on a vehicle to prevent those annoying scratches and dings. You get rock chips, rock hits your car. So it prevents those type of scratches on your car. Now, what we saw at that time is the company was guiding towards bringing margins higher. They had some one-time costs in their quarterlies at that time that really were masking the earnings power going forward. They took those one-time costs out of the business. Now going forward into 2018, tremendous growth in Q1, tremendous growth in Q2. Their last quarter, 65% revenue growth up to $330 million, and earnings came in at 8 cents per share from 2 cents in the same period last year, so a four-fold increase. The great thing is when you see a fourfold increase, and we said the price of the shares are up 300% this year, but you had a fourfold increase in earnings. So it is consistent with the underlying earnings growth, the share price growth. So we love when we can value a business that way. When we see it jump, when it came out with this first quarter, I think you can see on the chart there, when it came out with this first quarter earnings, the stock doubled, but the earnings were up about 400%. So it actually was cheaper on a go-forward basis, having doubled at that point. So we actually rebought again at $3 in that range, $2.80. So we still think here it offers good value in this range. We think at a 15, 16 times PE of next year's earnings, that gets you to $8, $9 from where you are right now. It's growth at a reasonable price. It's not going to grow earnings at 65% going forward, but if you can model at 20 to 25%, it's a good growth story, boring business, and if it continues to make us money, over the long term, we think it continues to do well.
All right, very nice. Let's move along to another top pick here of Ryan Irvine of keystocks.com. We're looking at Questor Technology. This is on the venture exchange, TSXV, QST is the ticker. I'm looking at a return over, I think it's over 5 years of 400% roughly, am I right?
Yeah, it's done very well over that period. It's a very well-run business. It is volatile, and we would always have a spec-related or a speculative buy on it. We have full buys and then speculative buys. This is because it's servicing a commodity-based business, and that underlying business has volatility. Management can do everything right. If the price of energy turns against it, there's less business for this company to service, and it can take a hit. Now, what we like is great balance sheet, net cash position, about $7.8 million in the bank, 28 cents per share of the market cap is in cash. Very profitable on a trailing basis, about 25 cents in terms of earnings. So it's just trading roughly about 10, 12 times in that range earnings. We think they'll earn 29 cents this year, so it's really trading at 10 times earnings. Despite tremendous growth in underlying fundamentals, it earned about 15 cents last year, so it'd be almost double. So that's great growth. What do they do? We should probably say, right? They have an incinerator technology that helps eliminate the harmful gases at the wellhead. It's a huge problem. It eliminates about 99.9% of the noxious gases that come out of the wellhead. Huge problem with flaring in the U.S., especially in the shale gas plays. And in Colorado, there's great environmental regulations that have gone in, which has been a boom for a company like Questor, increasing their fleet, their rental fleet in that market. They've just moved into North Dakota. They've mobilized a fleet there where the environmental regulations are supportive, and they're moving into Texas in the fourth quarter as well. So we would like to see them diversify because there's risk definitely being in one market like Colorado. Diversifying into North Dakota and into Texas will help that. And it's just a well-run business that trades at a reasonable valuation, and we like the growth prospects going forward. We think that 2019 will be a good year of growth for it as well.
Okay, very nice. So those are two top picks for you so far from Ryan Irvine. We have a question here from Jazz Rye, and it was on Expel Technologies. So you got your question answered there, Jazz, and thanks a lot for writing in. We have a question on photon control. I'll ask Ryan during the break whether he can talk about that. We're taking a break in just a moment. And we have a question from Warren Knight. This is interesting. I don't know if you know the number off the top of your head, but if you take Boyd out of your returns over the last, 10 years, what would your return be? Probably
I
still very good.
I would know they're still good, but I mean, you need your winners. You need your winners in your portfolio because you will have losers, and we have losers, right? And we say, if you're picking 10 stocks with our research, like next year, you sign up for our service, you're going to get 10 stocks potentially over the next year. We're going to have 2 or 3 that won't do well. So, you need your winners. You definitely need the Boyds in the portfolio. You need Expel in your portfolio this year to pick up, the returns in your portfolio overall. If you don't have those, your returns will not be as strong. But, we are looking for those gains, outstretched gains. One of the other reasons we're in small caps is because there's, Expel had 0 analyst coverage when we picked up on it. Not a single analyst was covering it in Canada. There's still limited coverage now, and it's the single best non-penny stock performance in Canada this year. So, you can find these companies that are under the radar that are potentially mispriced. It's harder to find a mispriced stock if there's 100 or 50 or 20 analysts covering it at any given time.
I think you mentioned that Boyd, going back to that stock, in the last 10 years was up as much as 5,700%, which you
Yes.
recommended to your subscribers many, many times,
Yes.
and maybe 25 times. Okay, now we want to tell you about a special offer from Keystone and Capital Ideas. We have, oh, my prompter skipped ahead. Yes, I'm showing the strings. We have a prompter. Maybe we'll just throw the board up here. I'll tell you exactly what you're going to get here in terms of this offer from Keystone Financial. Essentially, they have a number of different types of portfolios that they can give to you, and so now we can tell you that they have an offer for you, and that is you get their report, which is the Cash Rich report, and we're getting to it now. So he told you about the report that they produce. It's the Cash Rich Profitable Canadian Growth Stock Special Report.
That's a mouthful.
Take a deep breath. So, as he said, he reviews 3,500 companies along with his colleague Aaron Dunn and presumably some other people who work at Keystone.
Yes.
They narrow it down to 65. Then they give you 3 to 5 buy recommendations. So what you're looking at here is 150 pages packed with summary reports, statistical analysis, and then buy, sell, and hold recommendations. These are companies that can withstand downturns and prosper in market upturns. Now, this report has a value of $599. If you sign up now as a client, you receive it for free. If you become a client of keystocks.com, all you have to do is go to keystocks.com and you get this Cash Rich Profitable Canadian Growth Stock Special Report. You're watching Capital Ideas TV live with Ryan Irvine. 3 top picks are coming, more insights, and a bonus pick as well, so stick around.
We feel like we're the wave of the future in terms of how people test for things. We anticipate being the first sample-to-answer instrument that can process up to 22 pathogens at a time. Whatever you want to test for, you can do it on your own. You don't have to ship it away to a lab. You don't have to have an expensive microbiologist. It's something you can do on site. You collect that sample, you input it into the machine, you hit a button, an hour later you get the result you're looking for.
RavenQuest Biomed is really 3 things: innovation, science, and opportunity. Orbital Gardens are really cool technology. We've now converted them to the point of which the plant rotates around a center light. What we have done is created the control technology and changes to some of these gardens which allow for more nutrient impact into the plants. So what it allows for us is to get high density within a very small space, which overall is going to lower our capital costs and our operating costs.
Welcome back to Capital Ideas TV Live with Ryan Irvine, the founder of keystocks.com. Put your questions, as you're doing, for Ryan in the chat section on the right side of our YouTube channel page that you're watching right now. Now, Ryan has given you a couple of top picks. We have more to go, a bonus pick as well, more insights from Ryan Irvine. Let's get to some of these questions. Thomas Panett has written in. He wants to know about Photon Control. This is a company that we've interviewed. I talked to the CEO several months ago. We had a cover story on them. It's done exceedingly well, although it has been hit lately as the semiconductor sector rolls over. So is this something that you've held in the past, you hold now?
Yeah, we actually, I know Photon well. It's a good, solid business. We like it. We owned it 4 years ago from as low as 46 cents. That was our original recommendation. We bought again at 64. We bought at 80 cents, and then around $1.50, $1.40 in that range. It did tremendously well for us over a 4-year period. One of the items that we track on it is backlog, and almost year over year. I mean, there's some hiccups in there, but especially for a 2-year period, there was an increase in the backlog just quarter over quarter, and that's one of the things we track. And earnings, solid. The balance sheet here is tremendous. There's $42 million in cash in the bank. It's almost 40 cents per share. So it's trading just above $1. So 40% of the business is in cash. Now, what hit the stock? We actually sold half of our position at about $2.40. Not because we think it's a poor company or anything like that. It just hit the higher end of our valuation range. Plus, for the first time in a heck of a long time, backlog ticked down. So we saw backlog, or their orders going forward, tick down. At that point, we said, we had 400% profit on the table from our original recommendation. You got to take some profits or you never recognize them. Took them off. Now we're holding a half position right now. We're happy to do that. We think it's good valuation. Going forward, the company will continue to grow. The end market, the semiconductor market, is in a downswing right now. So the next 3 quarters, weaker year over year, we would estimate. We could start to see a pickup in that segment in the second half of 2019. Where we'd like to buy back in is when we see an uptick in backlog. So we'll be monitoring that backlog. If we see an uptick in that, it's a good business. The balance sheet is great. The wild card here is they could take that balance sheet and buy another business in a downturn. I'm glad they have the cash there now. That could happen. But we're holding off right now on the sidelines on the company.
All right, great stuff, Ryan. Thanks for that question, Thomas Panett. Here's a question from AJ. Brandon Chow. What do you think about the XBEC adsorption? This is XBC on the venture. You say you know it, but maybe you don't know.
Yeah, well, I have trouble saying their name. I do know that.
That's one thing.
We actually met with management in Toronto. We came in the spring. I think that the company's a good business. I think that they had a landfall contract that they signed, a windfall contract that they signed recently of $55 million. So that added to their backlog significantly going forward. The issue, profitability, the last quarter was actually decent. So we saw an uptick in profitability. That checks one of our boxes. They're guiding next year towards good. I think it's in the range of 5 cents. There's a wide range that they have in terms of their guidance, but it's in that range. If they hit that, in the current price that they're trading at right now, it offers decent value. We have to see management hit their targets. We like to actually monitor them and see if they put out a guidance and hit that. That'll confirm that we can trust the guidance going forward. So I think that there's a lot of potential there. There's certainly a lot worse companies out there. This is one we're monitoring, and we have it will be included in one of our special reports coming up, but it's not a recommendation right now.
All right, fair enough. Let's get to some recommendations. Another topic here from Ryan Irvine is Sylogist, and this stock has done exceedingly well. You're looking at the ticker SYZ, and this one's on the venture.
Yeah, we've owned it since around the $7 range. It's done tremendously well for us. It's really just a good, solid business. And the balance sheet, we keep talking about balance sheets today. $30 million in cash in the bank. It's like $1.50 per share of the company. There's no debt here. So this is a company, if there is a downturn, they will go out and make acquisitions in their market. What do? They provide software, so back-end accounting type software, enterprise planning software for nonprofit organizations, government organizations, and K-12 schools. So good, solid business. It's a SaaS model. About 70% of their business is software as a service, so recurring type business, which we like. It gives us predictability going forward. It's upped its dividends, I think, each year for the past 5 or 6 years now. We love that it pays a dividend. It's yielding about 3%. They just this month upped it another 18%. So, it's upping its dividend every year. Some years we've got a special dividend in it. We think next year they may take a little bit of pause in terms of growth, but that can change in a second with a good, solid acquisition. They made a good, solid acquisition of a K-12 software company just this time last year, and that added to growth over the course of this past year. We saw really strong growth in the business. I think that it'll earn 85 cents adjusted earnings or adjusted EBITDA this year. Right now it trades at a discount to what we think is fair value, around $16. So we think there's still a lift in the shares. You're getting paid that dividend. The company at any time could make an acquisition that would be accretive. So that's what we like. We like a business that has that can profit in a downturn, profit right now, And management has done a good job with this business. They own a significant amount of shares too. So we love to see them pulling on the same rope as us.
My one follow-up would be that it looks like it's not that liquid with average volume of 33,000. Is that
It's a very good
potential
point.
problem for a retail investor?
It can be, but we're looking 2 to 3 years out most often. So if you put a limit order in, if we put a buyout on this company, we always say, here's a limit. Say you're buying between 13 and 13.25. Stick that limit order in, have it in for a week even, and get filled over that time. Often you'll get filled within a day, right? But if you're trying to buy a huge position, you need to have that limit order in there, and it can be difficult. So it's not for every investor because of the lack of liquidity. But we believe, and we've seen this happen with these type of companies over time, the more as more people start to see the great cash flow, the earnings coming out, the more liquid it can become. The other thing is, companies like this with cash-rich balance sheets, cash and cash flowing positive and trade at reasonable valuations, they can get bought out. Now, we don't buy companies just because we think they're going to get bought out, but it can be a nice way to cash out on a company, if you've built a position over time, and we've had that happen a number of times.
Another stock you're recommending today is of the larger variety, nearly a $5 billion market cap, and this is more so from your colleague Aaron Dunn, but you know of the company as well, Parkland Fuel.
Yeah, no, it's a good, solid business. I asked Aaron, I said, let's have one income-related stock that also has growth that we can talk about today, and they're a refined fuel distributor for commercial, for retail, and for wholesale supply. So they also are the second largest convenience store operator in Canada. So at the pump, essentially, right? It's a good, solid business. They just made what would be another transformational type acquisition for them. They bought the largest refined fuel marketer in the Caribbean. So an interesting area to buy it in, but we think it'll be about 17% accretive on the positive side to distributed cash flow over the next year. We think it trades at reasonable valuations. We think it'll do a distributed cash flow around $3.60 this year. At just 14.5 times that gives you our fair value. Aaron's fair value right now is around $52. So that's a significant lift from where you are right now, and you're getting paid about a 3% dividend. So it's a good dividend, and it's a good, solid business.
What do you make of the rollover here? Is that just sort of standard consolidation and getting caught up in the downturn?
Yeah, I think it's an opportunity. There's part of that, but they had their last quarter. There's several analysts that follow this that had what we would say overly optimistic expectations, and the company had tremendous growth in their last quarter, but there was expectations out there that they'd grow beyond that. I think it's an opportunity to see this business grow long term. You buying it, at a discount. Like we said, these are the times when you want to buy, when you've had a correction, not when it's trading at 52-week highs. So we'd rather buy when there's been a correction, and we're holding this 2 to 4 years going out, and I think it offers good value here.
Okay, Ryan, you are watching Capital Ideas TV live with Ryan Irvine. We want to tell you about a special offer now from Capital Ideas. It's a free 30-day trial. This gives you immediate access to our premium weekly digest, which contains research-based actionable investment ideas that are reserved for our paying subscribers. So you'll get access to 4 issues, immediate access. You can find out what you're missing. Just go to capitalideasmedia.com and you can access it there. Take advantage of our free 30-day trial. Actually, do we have a board here? Take a look at the board, because I think there's a specific code they should be using. This Capital Ideas Media, and then you got / 30-day trial /. That's what you do. All right, so check that out, and we'll tell you more about that later on in the show. Now, you are watching Capital Ideas TV live with Ryan Irvine. One more top pick, a bonus pick, more insights to come right after this.
We feel like we're the wave of the future in terms of how people test for things. We anticipate being the first sample-to-answer instrument that can process up to 22 pathogens at a time. Whatever you want to test for, you can do it on your own. You don't have to ship it away to a lab. You don't have to have an expensive microbiologist. It's something you can do on site. You collect that sample, you input it into the machine, you hit a button, an hour later you get the result you're looking for.
RavenQuest Biomed is really three things: innovation, science, and opportunity. Orbital Gardens are really cool technology. We've now converted them to the point of which the plant rotates around a center light. What we have done is created the control technology and changes to some of these gardens which allow for more nutrient impact into the plants. So it allows for us to get high density within a very small space, which overall is going to lower our capital costs and our operating costs.
Welcome back to Capital Ideas TV Live with Ryan Irvine. He's the founder of keystocks.com. Put your questions for our guest in the chat section on the right side of your YouTube channel page that you're watching right now. Many of you have been doing that. Ryan has given you 4 of his top picks so far, 1 more to come. He's got a bonus pick as well. We'll also continue to take those questions of yours. So let's do full disclosure here. Let's make a very important correction. You referred to Tinder earlier, and we have gentleman writing in here, Pratzi, I think. He says, I think he means swiping left. Swiping left is bad. You're rejecting them.
Yes,
Swiping right is good.
I'm actually happy that I don't know that, because I think my significant other, she'd be very pissed off if I knew actually what swiping right and swiping left. So I should have known that swiping left we are discarding. Swipe right would be those very select few, like my significant other, that I would actually select, right?
Yeah,
so
and your significant other, and the swiping right, you're swiping right on your top picks today.
Yes.
So let's swipe right on Sangoma Technologies. This is your bonus pick today. The last year it's up 56%. Over 5 years, nearly 500%. So here's another beautiful chart and a nice looking company.
Yeah, it's been a great holding for us. Flies under the radar, but I mean it's a good, solid, unified communication business, providing VoIP-based phone systems for a business environment, all the type of voice data and communications that you need. On open source software systems, they just made a transformational type acquisition for the business of a company called Digium, which owned the Asterix platform. So a very under the radar story. This company a year ago this year just did about 57 million in revenues. It's going to do 100 million this year going forward. So tremendous growth in terms of revenues. Earnings, or adjusted EBITDA, the company is forecasting about 9 to 10 million this year. So that's a 50% rise from what we saw last year. When you have growth at that, trading at relatively reasonable valuations, we believe, based on their guidance going forward, their adjusted EBITDA guidance going forward, it's probably worth $1.60 to $1.70 right now, and that's not with any further acquisitions. They've been it is difficult to be a growth by acquisition story, because your return on capital has to be great with those businesses you buy to make sure that the dilution from share issues, to make sure you'll be able to grow earnings on a per share or grow cash flow on a per share basis. They've done that really well, walked that tightrope and done it well. We think with this acquisition, which is transformational to them, they will continue to do that going forward. There's the recurring revenue base has moved up to about 35% over the course of this year now. So again, we love those companies with those recurring revenues, and I think it just trades at reasonable valuations and trades under the radar. There's basically no coverage on the company right now, so it's one of those that we'll hold for 2 to 4 years, let management do their thing, grow earnings over time, and I think it will continue to perform well over time.
I said the chart was beautiful. The 1 year isn't exactly beautiful. It's okay, but the 5 year is really quite something. Now, you mentioned growth by acquisition. That makes me think of, say, a Constellation Software, for example.
Yeah.
Which beyond this one, which are the companies on the TSX that impress you in terms of being able to maintain that growth by acquisition?
Yeah, I mean, Boyd is a company that's been able to do that. I referenced them a couple times, just tremendously well and walk that tightrope. And they've issued debt to do it as well, and convertible debentures. Done it really smartly, and just been an absolute powerhouse in terms of acquisition, growth by acquisition. Enghouse is a company that we admire as well, run by Steven Sadler, a software company. They employ that capital, and they're not issuing shares at all. This is the model we completely love, because they make acquisitions out of internally generated cash flow. Right now, they have a record cash balance in the business. I think that they're smart allocators of capital. I think they'll continue to grow and outperform long term. We've owned that company for about 8 years. The dividend increases every year. The dividend's not huge, but it's nice to have that dividend increase every year. Share price over 8 years has done tremendously well. It's had a pullback of late. I think it offers value going forward, and it's just one of those stories that has been able to grow via acquisition. But there's no dilution there, and Steven Sadler, the CEO, owns a good chunk of the business. He's pulling on the same rope as us. Cash-rich company, relatively reasonable valuations. It's not cheap, but you're paying for a quality name.
Ryan, just back to Boyd, and you talked about a real-world example. As I was with my wife last night, she had a minor fender bender a few days ago. We had to go to this collision center in Toronto at about 9:45 at night. I would have rather have been on the couch watching Netflix or something, but I accompanied her, and there were tons of cars in the parking lot, all these bashed up cars, and it just shows you, maybe not as much as death and taxes, but it's just one of those things. People get in car accidents, and hence Boyd has this very steady business.
It's true, and I used Boyd to replace my windshield. I had a cracking thing. So it's great to actually use them, and it was a good experience. So that's good. So anecdotal right there is good. But people have concerns too. You wait. The autonomous driving cars, right? Okay, will we have less accidents? Probably. But their primary business is just glass repair, right? So you're still going to get those dings in your windshield, and even if there's an autonomous car, they're not going to avoid a rock chip coming up on your windshield. So we're looking forward on that, and you're still looking quite a ways forward till we have a substantial amount of autonomous driving cars. But we still think that business can thrive there, and you need those businesses that will thrive in a downturn or do well in a downturn, and we see it as recession resistant. So I think Boyd is still, it's not cheap right now, but it offers value right now, and it's actually come down from its highs of about $125. So we originally bought it at $2.30.
Nice.
People say we're crazy to get recommended at $100, but you look at the business unto itself. And if we think it has 20% growth over the next year, and you can get 20 to 25%, you still buy that business.
Okay, so now on to your last top pick among the 5. The bonus pick was Sangoma Technologies. Viamed Healthcare. Now, this is one that is being asked about by Jay Lee. And I believe he was the only one asking about that one. We had this as a cover story a while ago. Stock's done really well. Even with the recent pullback, it's still pretty well doubled in the last year or so, and this specializes in the obstructive pulmonary
chronic
disease.
COPD.
Right.
They provide vents into the home, ventilation systems, and the actual nurses essentially that help the patients with those and system on a 24-hour basis. So it's a great model. They essentially, COPD is a terrible disease. These are end-of-life patients, and you're helping their quality of life at that end of life. But what the cost of them going and getting readmitted back in a hospital is great. So the model seems to work quite well because you're saving the system money. Now, what has hit the stock recently? I mean, over the course of this year, tremendous growth in Q1, tremendous growth organically, all organic. That's the type of growth we like. And by organic, I mean they're not needing to make an acquisition to grow. But Q1, Q2, and Q3, tremendous growth in terms of underlying EBITDA and revenue on the top line, or organic growth. But there is the CMS, which is a Center for Medicaid and
Medicare.
I can't speak.
That's right.
That's right.
Yeah.
And they have come out and stated that this may go into a different payer category. It may. Sorry, I'm getting that wrong. The company may go to a bid process that is called a competitive bid process. They're not in a competitive bid process right now. It's kind of complicated, the process that leads to them getting a payer right now, but that could be a potential negative for the business. Now, that would not come into the fold for another 2 years. So they've had cuts from CMS in the past. Like in 2017 or 2016, they had a 35% cut. And the company, that's a negative to the business. It's a cut in the amount that they're reimbursed by Medicare. Now, that is a negative, but the company went out and just grew its business, grew and outgrew that cut, and produced the quality numbers and growth that we saw over the first 3 quarters of this year. We think they can adjust to that type of, it's well-run business. We think they can adjust in this environment, but the markets hate uncertainty. And when you have this type of uncertainty out there, that's why you see the very volatile trading in the company going forward. On an earnings basis right now, it offers good value. There's that, there's the uncertainty around the company. We think the management can navigate through this environment, and we would hold it as a spec buy in a portfolio right now. Maybe a half to a full position in the portfolio and looking out 2 to 5 years and letting management, again, doing what they do and grow that business organically. If you did not have that CMS uncertainty over this stock, it'd be a great buy right now. But that is there. This can happen. That is the risk with any company that's receiving payments from Medicare or Medicaid.
So Ryan, in our remaining minutes, what have we not talked about that you'd like to touch on in terms of investing advice or lessons learned or certain companies?
Yeah, I think that one of the things we always say is if you want to beat the market, that's what we're all really here to do. You can't just be the market. I think you need to have great stocks in your portfolio, but you want to craft that portfolio. You don't want to own 50 or 100 stocks because we always teach this in our seminars that we do as well. Past 20 stocks in your portfolio, a reasonable diversification within those 20 stocks, you're not getting any benefit of diversification anymore. So that's why we like to structure and buy with conviction good solid companies between 10 and 20 stocks in the growth-oriented area of your portfolio. And then if you do have an Expel or a Boyd in your portfolio, the returns that you get from that company actually make a difference. If you have 50 or 100 companies in your portfolio, first of all, it's very hard to manage. But also on top of that, a company has a 200% gain in a year. It's not a big percentage of your overall portfolio. So we would say that buy with conviction and concentrate. We say focused diversification. 10 to 20 stocks built, not bought all at once. If somebody comes to me today and says, give me your 10 buys, give me your 10 buys, I think that's the last thing you want to do. Because our system is we're buying over 6 months to an 18-month period, and that helps you avoid buying at a market top. So if there is a correction of 20% in the next 3 days, if there's a correction, and you started 3 months ago with our research service, well, you may have bought 3 companies, but you're gonna you're going to now be able to, and they may be down because there was a market correction, but you're going to be able to then add after the correction. So that's why we think it's the best methodology to buy over a period of time, not buy all at once because you have too much market-specific risk then.
Ryan
Hopefully
Irvine,
that helps.
Yeah, absolutely that helps. And everything you have said through this entire show, I'm sure has helped investors. Let's do this again. That was great.
I'd love to be back. Have me back anytime.
You could talk all day.
I probably could.
Yeah.
I get the sense, I could. We could go on and on. This could be a 2-hour, 3-hour show.
Well, see, the beauty of the internet, we could go 5 hours if we want. We won't do that. We're going to.
I got to catch a flight, so I don't know if I'm going to do that. But yeah, for sure.
Okay, thanks again,
Have
Ryan.
me back. Thank you.
Okay, and thanks for your questions. Stick around here, though. I want to tell you about these special offers we have from KeyStone and from Capital Ideas. We also have another live show planned Thursday, November 29th at 2 p.m. with Ryan Modesto of 5i Research. And then prior to that, a live stream as well at 12:30 p.m. Eastern Time. It's a live interview with Kirill Mugerman. He's the CEO of Kintavar Exploration. Now, we want to remind you of the special offers from Keystone and Capital Ideas. Become a client of Keystone today and receive absolutely free the cash-rich, profitable Canadian Growth Stock Special Report. It's about 150 pages. You get summary reports of 65 companies, plus buy, sell, and hold recommendations. Go to keystocks.com. Now, Capital Ideas is offering a free 30-day trial. This gives you immediate access to our premium weekly digest. And these are research-based, actionable investment ideas that are reserved for our paying subscribers. So you'll get access to 4 issues, and you can find out what you're missing out on. Just go to capitalideasmedia.com/30-day trial. Woo, mouthful. Okay, thanks a lot for watching and taking part. If you missed any part of the show, you can watch it on our website or on our Capital Ideas TV YouTube channel. Thanks again, and we'll see you next time. Bye for now.